Hey guys, welcome to another Mortgage Minute with Pat. As part of this fiscal cliff stuff went down, the American Taxpayer Relief Act of 2012, sorry I don't have that memorized yet, did reinstate retroactively mortgage insurance deductibility on your tax return. So let me just give you a little bit of info here. I've attached it. This is really cool because through 2011 you could deduct mortgage insurance if you're paying it out of your income, depending on your tax bracket or your income level, but I'll get into that in a second. What they did is they went back and they said if you paid it in 12, you're going to be able to take it a deduction on your returns, depending on your income, and it's also going to apply for 13. So that was kind of an unexpected, really positive thing from that. That has to do with $100,000 a year gross adjusted income, adjusted gross income or less, and you can make that deduction. Deductions are still available a little higher than that, but they start to phase out as you go up there in the income bracket. So mortgage insurance is a tool. A lot of times people view it as a negative, but it's a tool to help people finance the home without a 20% down payment. So it's actually a good thing. It applies to FHA loans, conventional loans, USDA loans now. It does not apply to our veterans loans. So if you're wondering and you need more information, you do want to do some tax research and really check with your accountant or the CPA to get absolute advice on that. Speaking of mortgage insurance and FHA loans, FHA does look like it's still a widely used product. If you've been following me or following the markets for the last year or two, you've noticed that they've increased the monthly mortgage insurance premium that people do pay quite a bit over the last couple of years. Okay. They're talking about further increasing that. Okay, so right now, today, is the cheapest time to get an FHA loan. Going forward, it looks like there will be some kind of increase, and the increases in the past have been quite a bit. So I've also attached on here a really cool kind of graph and printout that looks like this. It's got a couple pages. And what that shows you is what it looks like to finance a house for $400,000 today using FHA financing. What it would look like as they make the changes in a higher interest rate climate. So one of the things they're talking about doing is right now you pay mortgage insurance for at least 5 years on FHA loans. Okay, after 5 years, if you have enough equity in the house, more than 20% equity, 5 years goes by, you can have the mortgage insurance dropped out of the picture. Okay, so a big part of your payment goes down. Fantastic. One of the things they're talking about doing is making that mortgage insurance permanent again. They used to do that up to 2001, so they toggle back and forth with how they do that. They're talking about making it permanent. So what I've put below here is a graph that shows what happens if I take a loan today versus I wait until they make that mortgage insurance permanent, and what happens if rates go up in that permanent mortgage insurance environment to 5% and then subsequently 6% compared to today where they're close to 3%. So that sounds like, to someone looking for a house today, like a pretty big jump in rates. But just remember, a year and a half ago, rates were almost 5%. So, and historically, a 6% rate is fantastic. So just keep that in mind as you look for a home. Look at the payment savings. They're anywhere from $50,000 to $100,000 over 5 or 10 years buying today in the low rate environment versus having some of those FHA changes happen, plus rates going up just a couple percent. Okay. If you want me to set one of these examples specific to your scenario, just get in touch with my office, whether that's a price point or plug in certain rate expectations, and we can look and see how it applies to you. Okay. Thanks.